20 pips or more than 20 pips.
Yeah.
At least 20 pips.
So that just
And then we
breathing
start
space.
trading it. We trade it 5 pips above. If you're going short, above
I mean,
20.
there's an entry.
Sorry?
There's an entry point.
The entry point is here. We already entered here.
Yeah.
Now we're trading the
Trading,
stop loss.
okay.
So to trade a stop loss, we wait
You put 5 pips.
Yeah. until the next bar is moving 20 pips away from the 20 EMA. Here. And then we trade it 5 pips above the 20 EMA. And once we trade it, we keep on trading it until we hit the stop loss or we hit our stop.
You don't move the target.
No. We
Fixed.
never move the target. The target is there.
Even though it's in your favor.
Yeah. We just follow the rules. Always follow the rules. Let's say your target is
And you
here.
don't add to the profit. You don't add extra profit. For example, if you make and then you think that you can make some more,
No.
and then you don't add more.
We just follow the rules.
All right.
We follow
I
the
was
rules.
just gonna answer. I think those are extras when we master the basic.
But for now, we just
Stick to the. As soon as you hit your target, you.
we are out of the trade. So once we hit it, we exit by target or stop loss.
Yeah.
So we don't like cancel the trade or anything. Once we're in the trade, we're in it.
Yeah.
So we just keep on moving our stop loss like this.
I suppose you
Is that
can
correct?
once you are advanced. Once you can add more.
You can't add to the position yet. So let's say sometimes the lift off, let's say for example, it pulls back a little bit, right?
Mm.
And it sets up another lift off strategy and it hasn't hit your target yet on the first one. Then you can add a second position.
Yes.
Does that make sense?
Also.
Yeah. So you can, why not? Yeah. Because we call this is called scaling in, right? You know that?
Yeah.
Scaling in, yeah. So you can do that.
Yeah.
Nothing wrong with that. Master the markets.
Any question?
Hello? Hello? Calling me, not talking to me. Hello?
Any question?
Fine.
Everyone cool with the lift off? Oh,
Yeah.
you cool with it? Yeah.
Yeah.
And Joe?
Yeah.
Yeah. JD? Yeah. Good. Right. Good. Brilliant. Good presentation. Okay.
Who's penny? Mine.
Quick comment.
Grab it, yeah.
Okay.
Very much, sir.
Thank you very much. Well done. Very good. Okay, so let's move on. And I thought what we'll do is we will do a recap of the dynamic breakout. Okay, and we'll do a recap of the dynamic breakout. And we'll do a recap of the price run as well. Because Fiona has just joined. So hello. Hi, buddy. Say your name. I'll give it a couple of seconds. It should definitely come through. Rita@sonarastudios.com. Yes, and literally 3 minutes ago. If it doesn't get to you in 5, then just let me know. We're just about to, go into some stuff. Yeah, top man. I'll resend it again as well anyway. Cool. So we're going to go over the dynamic breakout. And so dynamic breakout is all about breakout of what? Does everyone remember? Oh, when we look at the breakouts of on the dynamic breakout. Joe, you might know. So Sonora, what do we look for breakouts of on the dynamic breakout? Breakouts of?
The trend.
Yeah.
Trendy.
But specifically, what type of support and resistance?
And swing and highs and swing low.
That's it. Everyone remember that? Joe?
No,
No?
but we
Okay.
did it last week.
And Abel, do you remember that?
Yeah, I remember
Oh,
that, yeah.
you said it. Oh, what about you?
Yeah.
Remember? I say it
I don't remember.
I say it every single night on the live trading room. Dynamic breakout is all about breaking out stocks, swing highs and swing lows. I thought you guys would have all gotten bored with that by now.
It's not-
Never
yeah.
forget that again.
No, this is not covered in the Traders Base Camp.
Yeah, that's all.
Oh yeah, no, it's not. No. So are you on the Dropbox? Do you have a Dropbox folder?
Yes.
You have? So let's switch this on. We'll check. So they can
That's what I
check
was-
to see if the Dropbox is set up. You have to do it.
the Dropbox.
Yeah, just put it up here, I'll set it up. Okay, so, yeah, go on. Joe, how cool do you feel about the dynamic breakout? On a scale of 0 to 10.
7.
Okay, that's good. Oh, what about you?
4.
4, okay, very good. And Abel?
5.
Brilliant, very good.
Um,
No, I know you didn't trade
I
it.
don't trade it,
Yeah.
I just
You understand, okay. What we'll do is just very quickly, we'll go over the concept and we'll go over the 6 variations. Yeah. It's just good, it's nice to have a little bit of knowledge, and even if you're not trading, I know it's just nice to have a heads up, yeah. And then we'll do some coaching and things like that, then we'll start some awareness. But it's see, the dynamic breakout that was originally constructed by some of the members of the Vedanta Elite team. So they started doing some research into trend variations. So when we talk about uptrends and downtrends, see, like a lot of people say, okay, so for an uptrend, the definition is higher highs and higher lows. And for a downtrend, the definition is lower lows and lower highs. But really, no one has gone on to like really break down the definition into anything that really means something deeper than that. Because actually, there are many different variations of the trends. And then there are also different statistics around if you get how often these types of variations, things are set up. Okay, so I'll give you a little bit of better understanding in terms of what I'm talking about. So, dynamic breakdowns. Okay, so don't forget, dynamic breakout is one of the strategies, the second strategy that we trade in the live trading room. First one we just covered, which was the lift off. Okay, good. So, now, with the dynamic breakout, here's how it all works. All about breakouts of swing highs and swing lows. So let's say that the market is doing this. So here, this point is a high, and this point here is a low. So really, these first 2 points on this trend are reference points. There are reference points because everything else is going to be referenced back to those 2, right? So here, this will be a what?
Swing low.
Yes, swing low, and what type of swing low specifically? A
Higher. Higher.
hello. Hello. Oh yeah, absolutely, sir. Yeah, that'll be good. You can do that. Can you just open the door?
Is this for day trading or
End of day. Definitely end of day.
End of
We should lock the door if people are late. They can't come.
Yeah.
We should do the next one. That's what they would do.
So this is end.
But actually, I can't do that because I'm late everywhere, so we won't be able to enforce it. I'll be late to the session.
Just have to
No,
put
sorry.
on you.
Okay, so, right. Okay, here we go. So what we'll do is, this point here is what?
It's a swing high.
Yeah,
A higher,
a higher,
higher.
high. And why is it, Joe, why is it a higher high? In reference,
The last time.
is exactly, yeah, that's it, exactly. So, it's higher than the last high, so we call it a higher high. That's all it is, really that simple, yeah. So then what does that make this one, L?
That's a higher.
Yeah, exactly. Why is it higher though?
Because it's higher than the previous low. Previous high.
Previous low, yeah, no.
Previous low, all right, sorry, yeah.
It's the higher low.
Yeah.
It's higher than the previous low. That's it. Does it make sense?
Yes.
Yeah, it's very logical, right? So this would be an uptrend, and it's an uptrend because it has higher highs and higher lows. That's all it is. Very simple, very, very nice and straightforward. Yeah. Hello, sir. Welcome. Okay, so high and high, higher than the previous one just here. Now, this is an upward trend. Very straightforward. Now we build on this a little bit. Okay, we're going to build on this a little bit. Now, how do we trade this? So, in the live trading room, when we're trading dynamic breakout, what we do is once we reach this point just here, and the price is, let's say it's here, let's say as of today it's right here, okay? Once we reach this point, what we're then looking for is we will place a pending order to open on the break of this last swing high. And this will be our entry long. Make sense?
You wouldn't do it in the first high.
You would do it. Yes, we do it. Yeah, okay. So this whole thing could be happening here, like it could be happening there as well, absolutely. Or it could happen here, or it could happen on the next one as well. Yeah. So if you look at something like the right now, if you look at the euro dollar, then it's done so many of these, and we just keep entering short, you know. And today the one just hit our target, right? So this is the dynamic breakout long. Does it make sense?
Yes, it does.
Not really a bit confused? Okay, Joe had to find this so far. I haven't finished everything yet, but do we get what's in between these lines here first of all before I carry on? Because I'm making lots of assumptions. So these lines, do you know what these mean?
Just bubbles.
Yeah, just bars. That's it. Yeah. So within these, it's just easier for me to draw it like this.
But they're passing.
And then there's bars inside here. Okay, draw some bars. Yeah. So they're all inside here. And we just draw, all I'm doing by drawing the line is drawing all the close prices. Yeah, so it just makes it much faster, right? So we've got that. So then remember there is a bar that's formed this swing high just here. Yeah, maybe it looks like this or something. Yeah, there's a bar that's formed this swing high. So the dynamic breakout, what we do is we place an entry order when the current price bar is here. Let's say this is today. Let's say this was 2 weeks ago. Yeah. Let's say that was 2 weeks ago. This is today. Now, what we do is we place a pending order to open, right? A pending order to open, and we place a stop loss just here. We place a stop loss just there. The stop loss isn't placed exactly here. It's actually placed. Yeah, so it's placed at this price level, right? This is our stop loss price level, and this is our entry price level here. So the dashed line is our entry price level, and the solid line is our stop loss. Does it make sense so far?
Yes.
Oh, how do you feel about this?
Yeah.
Yeah.
So it's on the bar that make the higher high, right?
Exactly. Say it again.
It's on the bar that make the higher high.
Does it make sense?
Yeah.
Yeah. So we place the entry and the stop loss on the bar that makes the higher high. The bar that defines the swing high, the highest point of this spike, is the one we place the order around. Yeah?
Any gap at all?
Yes. Let's talk about the gap now. We can talk about the gap.
Okay.
So now, let's do this, yeah? Let's take this price bar here, and let's zoom in.
Okay.
Let's zoom in. Okay? So this is what's happening actually here. Something like this is happening. Yeah? If we zoom into this section, you see this part, the peak? If we zoom in, it actually looks like this.
Few bars.
Yeah, would that be fair to say?
Yes.
Yeah. Joe, you cool with this? Yeah. Entry. Stop loss. Up? Yep. Perfect. Okay. Now, the entry is placed 3 pips above the high. The stop loss is placed 1 pip below low. Entry 3 pips above the high, stop loss 1 pip below the low. Everyone Everyone's happy with this so far? Now, let's go back to our less zoomed out version, which is over here, yeah? Let's say we place these orders, and then the price starts to move higher. Once it triggers over here, we'll begin the trade. Okay? Now, this type of dynamic breakout, this one that we've just discussed, this is the most basic variation because it's in line with the current trend. The trend is already established as an upward trend, so we call it a trend exactly established breakout. Yes, a trend established breakout. So Tiru calls it T-bird for short, because it sounds cute. T-bird. If you watch Tiru ever speak about T-bird, you'll see some smile on his face. Right, it's a trend established breakout. Why? Because the upward trend is already established, and all we're doing is taking the breakout of that already established trend. Yeah, very straightforward. So, because it's already established, a trend established breakout is a dynamic breakout variation 4. Yeah. So if you look at the dynamic breakout variation 4, this is basically how it will be broken down. The reason that I talk about variation 4 in that order is because it's the easiest one to understand.
Yes.
Because it's already trend established, it's already higher highs and higher lows. We place our entry, we have our stop loss, and they're all managed in the same way once they trigger. So I'll teach you the rules for how we trail stop loss and all of that afterwards. Let's just quickly run over all of the variations. Joe, do you open that window just a tad? Right. So, variation 4, dynamic breakout. Now, let's talk about variation 1.
Is 5 not just the reversal of that one?
No. The reversal, when we say reversal, I'm going to be very careful with the terminology as well. I'm guessing you mean the inverse, the opposite, other way around, so short instead of long.
Well, I thought last time we did it where it went down and then went up and then went down.
Yes, that's price run and it's variation 5. That would be right. But there's some very specific criteria around it, which we will definitely go over. Variation 1.
We're doing variation.
Let's do variation 1. Now we'll go in order because it's we've got the easiest one out of the way. Yeah. So, with variation 1 is a trend defining breakout. A trend defining breakout. This is variation 1 dynamic breakout. T, D, D, O. Trend defining breakout. Okay. Now, the way that this one works is that we have a trend that's already established. So again, same as before, high, low, higher low, higher high, higher low. Now the thing that happens differently here, on the defining breakout, the thing that makes it a variation 1, as opposed to a variation 4, is real simple. All that happens now is the price moves higher, and where we would expect it to be a variation 4, and where we would expect it to break this swing high and carry on going upwards, what actually happens is you get a lower high going into this market. Lower high. The price starts to go down here. So it forms a lower high. So now what happens is we have a lower high than the previous high. Now, that means there's now, at the point where that lower high is established, that now means there is a 70% chance that this swing low here will be broken before this swing high is broken. 70% chance that this swing low here will be broken before this swing high is broken.
Variation 2 or 1?
This is variation 1. So
Yes, it's a 2.
there's a very slight distinction between variation 1 and 2. We'll cover that. It's a very good point. You're absolutely right. It could set up, if we added one more small criteria, it could be a variation 2, and that's the next one. Now, the key thing about the variation 1 is that it breaks. And what happens is we enter this market short. So our entry is actually on the bar that makes this swing low just here. Entry. Stop loss. So again, if we zoom in, into this section just here, if we were to zoom in, %70% probability. If we were to zoom in, you can see something like this happening. Okay, now, with this, our stop goes on the bar that's forming a swing low. Okay. That's the entry, the stop loss. Stop loss with the target time. Entry with a dash. Variation 1. Now, in the variation 1, we expect that to continue moving and break that swing low. There's a 70% chance it will break this and enter us before it goes above the high. Oh, yes, of course. Apologies, sir. Thank you.
All right.
Our weekly planning session is being broadcast as far as Leicester. Soon we'll get to Scotland and then we'll go global.
Wonderful.
Right. The bottle was in the way of the shop.
What's that like?
Yeah. It's going to Leicester right now. If you, actually, everyone should wave into the camera.
Hello.
Hello.
Okay.
Adios, amigos.
Right. Okay. So right. Okay. So that's the whole idea of variation 1. Okay. The variation 1 just there is all about reversal of the actual trend. Does it make sense to everyone so far?
And the gaps for the stop loss and entry is the same as the previous one.
Gaps for the stop loss. That's right. Yes. So it's going to be the gap will be the distance of the bar that makes the swing low in this case.
Yes.
The last one was the distance of the bar that makes the swing high. Yes. This is the variation 1. So in the variation 1, remember it's the lower high and it breaks and it enters the market short. It defines a new trend because what was an upward trend, the second that this was broken and entered us into the trade, became a downtrend.
So
The second that swing low was broken in this upward trend that was already established, the second that happened here, this bar that entered us in the trade, where our entry was this bar here, that exact minute that it broke and entered us into the trade anywhere during the day, it became a downward trend. Up until that point, up until this bar here, this whole thing was still an upward trend.
So the trend is reversed.
Exactly. and now we've defined a new trend. Where it was an upward trend is now defined as a downward trend. Trend defining breakout.
And people would say it's a market structural failure.
Exactly.
But
That's
seriously,
exactly correct. They're very good. So yes, that's right. It's called a structural failure. Yeah. Because what's happened here in a nutshell is it's like if you had built a house, it would be like removing one of the absolute key bricks that built the foundation and taking it out, and eventually the house will start to fall over, albeit slowly or whatever. Yeah. So trend defining breakout is a price structural failure. So this is all variation one. Yeah. Lower high.
The entry is in both or in
No, the entry is in this bar that makes this swing low. So our entry is on the low, stop loss is on the high. So if we zoom into this, this is the chart as it stands here. If we zoom in, it looks here. And our entry is on the bar that makes the swing low, the stop loss is above the high. Does it, Joe? Are you okay?
Richly,
Yes.
yeah, getting a bit confused with this diagram. When I was following you, I had no problems. But now when I look
Let's
at
look
this,
at the diagram. Everyone's got this diagram. So
Well, I
this
suppose,
is in your Dropbox. I'll set it up for you in just a moment. Okay, good. So this is a variation one. Okay,
version 2, isn't it?
it is. That was a test.
Yeah.
I forgot which order he put it around on the sheet. So this is actually variations. That's what it is. All right. Yeah.
No, because also the lower high. Oh, yes.
That's
yes.
right. So what's happened here is it is a lower high. It is a lower high. What's happened as well, actually, the reason this is a variation too. So totally my mistake. I just forgot which order he put the different variations in. The thing that differentiates a variation 1 and a variation 2, so I'll tell everyone so it's very clear. The thing that differentiates it is that inside of a variation 2, according to the live trading, I'm going to redirect it. It's a little bit messy. I'm going to redirect it directly. We'll come back to variation. So variation 2, according to the live trading room model. So a variation 2, according to the live trading room model, here's a high, here's a low, here's a higher low, here's a higher high, here is a lower high, here is a high. According to the live trading room model, this crib sheet here, the variation 2 is called a variation 2 because when we look at what I'm going to do now is I'm going to measure the range, the range between a swing low and a swing high. I'm going to measure the range, the distance, right? I'm going to measure the distance. So the distance from this swing low to this swing high is this amount. Is that fair to say? Is that fair? Yeah? Everyone with me on this? So the distance is from here to here. That's from the low to the high. Fair? The distance from here to here. Right? Yeah. The distance. Now, distance from this swing to this swing line. Yeah. Would it be fair to say, Vienna, would it be fair to say that this range, is within this range? So this is called as an inside compression. And an inside compression, according to this crib sheet, is variation 2. Exactly. So you heard of symmetrical triangles? Yes, this is the breakdown of what is called as a symmetrical triangle. Okay? So it would be like this. We're joining this point here, and we're joining this point here. Yeah? See, people talk about symmetrical triangles, no one can really define it like this, right? At this point, it's without definition. So what's happened here is this lower high tells us that there's a 70% chance we're going to break this swing low. 70% before we break this swing high. 70% chance to break this low before it breaks this high. When we see this inside compression, what's this term, Mr. Hassan? Inside compression. And it's an inside compression because this range is within this range. This range is within this range. It's inside variation 2. Yeah. So this variation 2, we would trade it short, and it's a trend defining breakout.
You want to know the both ways.
You will put an order both
Always.
ways. You will. Only up until the point this lower high forms. Now somewhere when you get to around about like this, then this lower high is confirmed. Then I will cancel this order up here. I will only have a order here. Because this is now a 70% chance going to break this low, 70% chance going to be a downtrend. So this 70% chance going to be downtrend, I don't want to trade up here anymore. Yeah?
But you will at this point go to those.
Yes. Up until, if this lower high has not formed yet, if it's just higher highs and higher lows, see, up until this point it's still an uptrend, isn't it?
Yeah.
Before that lower high has formed here, before that lower high forms, it's still an uptrend. So I will place a dynamic variation 4 to enter long here. I will expect this to happen. Because why not? It's higher highs and higher lows. But when that thing happens and we get this lower high point and the price starts to move down like this, at that point I will cancel that order long. And I will only have an order in the market to trade short.
But no, if it is enough time, you will need to wake up.
Yes. Unless you see a reversal. There are many examples. Yeah, many examples of this lower high. So there was a good example on the cable back in June. Go back and you look, and then you see the cable as a lower high. That was our first signal of the markets. Euro again as well. Exactly.
Couple of months.
Yes, couple of months. All of them, I think, back in June or July. Yeah. That was our first signal that the market was going to reverse. Yeah.
And is this what time frame?
This is all daily. You can actually, the beauty of these concepts that we're teaching here, it can be traded on any time frame. But our results are tested on the daily. Yeah, our testing is on the daily. But this is end of day, yeah. But the beauty of this is that any time frame you want to trade it on, you can trade it. Because they're just price concepts, right? This can be 1 minute chart, it doesn't matter, does it? Because you're getting the higher highs, higher lows, it's price action.
So they haven't been tested.
No, I haven't tested it. 4 hours. Joe, does that make sense? It could be these bars in between here could be any time frame. They could be 1 minute bars, or 5 minute bars, or hour bars, or 4 hour bars, or weekly bars. It doesn't make a difference because it's just telling us where the highs and where the lows, and where the highs and where the higher highs are the bits are. Cool. Right. That's a variation 2. So then, if that's variation 2, then what is a variation 1? So, according to the live trading room, a variation 1 you buddy can help me to define what these points are. What's this one here?
No.
What is it? No one else.
Similar.
It is a swing low. What do I label it as?
No.
Just low?
Yep.
Not lower low?
No.
Why?
Because that's not
Perfect.
That's fine.
Perfect. Good. Right, what shall I label this one as?
Higher. No, high. Sorry, just higher. Sorry.
Okay.
Itch.
Okay. And then this one?
That's a higher.
Good. And then this one?
High.
Perfect. Does this make sense? Yeah. And then this one?
High low.
Yeah.
High.
That's it. Okay. Now, a variation one will look like this. So, remember, with the variation two, what happened is we saw another higher level forming, and then it made a lower high, and then it came down like this, right? That was what happened with the variation two. Now, with the variation one, that doesn't happen. All that happens is we just break this swing line. This is a price structural failure. Where we had a perfect upward trend, a new trend has now been defined.
What happened with the British?
Exactly.
It just went down.
That's right. I don't know if it did actually, I'm not sure about that.
So what Malaysian airline food is happening in uptrend? Or
They can happen in both trends, we're only giving examples.
Oh, right.
When we give examples for short term variation. Yeah. So if the market trend was long, up, we're looking for long opportunities. If the market's trend was up and we're getting higher highs and higher lows, and immediately this swing low breaks here, the very bar that breaks this higher low here, the second that happens, it doesn't even have to close. It just has to break this swing low here. The second that swing low is broken, this entire trend is a downward trend. Does it make sense? Are there any questions? Variation. This is very basic. Uptrend, higher highs and higher lows. Reverses.
Rishi, all over us.
Yes.
Sometimes I find it difficult to establish when the if it's a just defining the high or the higher low.
You won't be able to define the higher high or the higher low. You have to look at the live trading with the rectangle as well.
I don't know, say if you trade on the without that.
Then you're right, it's very tricky. Or if you don't trade by euro then. What we're going to do now, that's what I could answer. So what we're going to do now is we're going to design an indicator which will basically hook up to, we're going to buy a server, and it's going to sit there in real time. And this indicator will basically, it will send signals to a website which you can just dial into any time, and it will tell you all of the swing highs and swing lows for every currency, every time frame. And it will be in real time. So as soon as you open the web page, it will tell you euro dollar, last swing high 136.70, last swing low on the daily, last swing high on the 4 hour, this price, last swing low. So we're going to do that. But yes, you're right, if you're trading by yourself, it is very difficult to define where the highs and lows are. That's the thing we struggled with for several years before we had a definition, a quantitative definition. Yeah, so that's where we are, just there. So that's the variation one. Make sense, Joe?
Yes.
What trade would you trade on?
When you say what trade, what? I'm not sure the question.
What trade would you be placing?
Which direction?
Are you putting the entry at high low? That's like high low.
Yeah, correct. This high low is will be our entry.
So where's your
Our stop loss is on, there's a bar inside of this entire formation here that's made this lowest point, right? It will probably look something like this. Yeah. Our stop loss always goes, if we're doing this direction, on the high of that bar. That's where our stop will go. So if our entry is here, our stop would be there.
It's,
Because it's all there, so 3 pips below the entry, 1 pip above.
No. Plus 3 pips on the high, always the buy order, which is always the order on the high, always has the higher number of pips added to it. Yeah, I'll show you one in just a moment. 3 pips here, and then minus 1 pip from the entry. See, from the low just now. Yeah. This is how we'll enter this to go short. Now, good question about what happens on the other side. Okay, let's look at the variation 1 and the inverse. Yeah, as if it was a downward trend, breaking to become an upward trend. Yeah. Now, in a downward trend, let's see who's comfortable to answer this. If you're not comfortable, then you can. Who wants to have a go at defining these ones?
I was told that if I did, I'll just do it anymore. Oh.
Fantastic, good job. That's perfect. Does everyone agree with this? Understand? Yeah, pretty straightforward, right? So, now, what is a variation 1 when it's a downward trend and it's becoming an upward trend? It looks like this. So, perfect downward trend. Textbook downward trend, yeah? Price comes, it breaks this swing. There'll be a bar here, the stop loss, the entry will be here. Yeah, so for the entry, we'll go 3 pips above the high, minus 1. Make sense? Are we cool? In inverse. Any questions?
Yes.
It's better to ask questions because if you're not sure, then you'll remain not sure forever. How do you trail the stop loss? Remind me of that one after we've done variation 2 or variation 3.
Yeah. I don't know if we should ask now. Is it on the size of the bar with regards to risk? Is that something you can answer afterwards?
No, it's not. See, you have to, in trading there's so much terminology, right? And what's really key is to be very clear on the question you're asking, right? So, I know what you're saying, but the way that it's phrased isn't quite right. So we just refine the phrasing just a little bit. So the question actually isn't, does it depend on risk? No. Because remember, our risk is always fixed. So our risk is always going to be what? Set. So what it is that if the bar is bigger, then and we're looking for a 2-to-1 reward risk ratio. If we have a bar that is 250 pips, that means we're looking for a target of how many pips after the entry. Yeah. So that means that the market, current market especially, can take so much longer to get up towards 500 pips, if at all. So I would ask myself, do I really want to hold a trade for such a long time?
No.
Or do I want to get involved in a market like that? And what will happen is the difference between taking a trade for a bar that has 250 pips of trade risk and a bar that has 50 pips worth of trade risk is real simple. It's that, first of all, this is 100 pips only towards target, this is 500. My position size on this trade is going to be a lot bigger, right? If my position size on this trade here is £5 per pip, £5 per pip, let's say. The position size here would be £25. But the risk is the same. The risk is a percent. Because if you multiply 5 by 250, you're going to get what? Right? Which would mean how big is this account? It would be... Okay. No. Yeah. And if you multiply this is 5 times smaller, so my position size should be. In fact, this looks more right with this. Calculator. This is why I do mental maths. This is why I failed A-level maths. This is why I use a spreadsheet.
1,000.
Thank you very much. 5 times 250 is actually 1,000, that's what I thought. So 1,250. Right? Which would make this, as we said originally, 125. So your account size is that, your risk on the trade is that, okay? And on this trade, if you multiply 25, this is just a reverse calculation of what we've done already, right? Basically, 25 times 50. Same thing, 1,250. Yeah, you can do the math. I'm not going to do any more math without a calculator. You do the math, 1,250 is the same account size, but the position size is bigger. But the risk is always 1%. So it's not that the risk is bigger. What it is the trade risk in terms of pips is more than on this trade just here. So they're just very slight, kind of understanding of how to phrase the terminology.
Yeah.
Very good. Yeah.
But if you've got a smaller account,
Yeah.
you shouldn't really go for it.
If you, and again, like, so let's define. If you speak to either me or Thierry, you're gonna, if we don't like stuff like smaller, bigger, larger,
I know,
whatever,
right?
So we'll define everything, right?
Yeah.
So if it's a smaller account, again, if you have a, yeah, again, if you have a smaller account, your position size will be smaller. Okay, but, right? Bear in mind one thing. If the account, let's say it's very, where it's a tiny account, right? Let's say it's £1,000, then perhaps the position size here would not be big enough for you to be able to place the trade. That's where you have the issue. Yeah. So obviously, if you're undercapitalized, and the bigger the risks, the trades with bigger trade risk in pip amount, you can't take. Yeah.
You're risking too much. Yeah, this is
Exactly.
This is where I was uncomfortable.
Yeah.
Yeah.
You can risk a bit. Comfortable reason.
Absolutely. Yeah.
So you just forget that trade. You don't.
Precisely. What you can do, as Kabir says, is you can have a money management rule that says that you can risk maybe 2 or 3% on a trade.
Depends how confident you are.
Depends how confident you are on your system, your results, your statistics. Right? There's nothing wrong with risking more, as long as you have a reason and you're consistent.
Yeah.
But it's not possible to risk more on just a trade that you like to look on. That would be gambling. Right? So we have very clear criteria as to when we risk, how much risk. So sometimes if you look at the live trading journals, some people have seen this already, sometimes in the journal I put number of pips of risk, percent risk on this trade, I'm only going to risk 0.5% as opposed to the full percent, yeah? And there's a strategic reason for that. Maybe I'm taking a lift off in a trend that's already broken and a new trend is defined. Maybe I'm taking a lift off long in a downtrend. In which case I'll only risk 0.5% because my odds are already against me, aren't they?
Yeah.
If my current on the whitewater rafting in the river is down and I'm trading the other way, my odds are against me to some extent, then I drop my risk. But I don't just do it randomly, it's because we have a strategic reason. So again, if you have a strategic reason to want to risk more, then there's no Does it make sense?
Yes, it does. But some other people that say, they don't explain it like you do. They say, don't risk them 1% and that's it. More than 1%. So
Absolutely.
they don't
That's,
really-
and it's
they say
important.
why.
It's important at the early stages to have that mentality because it builds discipline. That's all it is. But of course, after a point, after a certain point, you're going to want to risk more than just 1% because obviously, if your goal is to make, it depends what your goal is. If your goal is to make an income and you're trading with a smaller account, and again, like small account for me is defined anything less than $250,000. And if you want to make an income, then you risk a little bit more than you quite comfortably can make an income. Now, if your goal is different, and your goal is capital preservation, or just literally getting a slightly better rate than the bank is offering, then you may only want to risk 0.25% or 0.5%. If you're trading, let's say, 2.5 million, then you want to trade slightly smaller, right? Fine, exactly, perfect. And that can also work as well. Yeah. Or another method of risk management. Yeah. Or another method of risk management is by looking at pips and saying that you won't risk more than 50 pence per pip on any given trade. Again, the key is consistency, right? But be prepared to take bigger hits when you're trading with bigger bars like 200 pips. Yeah. That's the key. But again, if you're consistent in that approach, it can still work. And Abel's calculated how many pips he's made. So if he's trading a consistent amount per pip on those trades, then you can make a profit in that way as well. There's nothing. But again, like I would advise at the beginning, at least the first 2 years, 2.5 years, just trade the percent risk, and then you have a really good feel for what you're doing, and you can vary, and then you can build a plan as to when you risk. Make sense? That's good. So we've been over the variation 1 dynamic breakout, we've done the variation 2 dynamic breakout, and we've done the variation 4. Okay? So remember the variation 1 and 2, these were both trend defining breakouts. The variation 4 was a trend establishing. Again, Abel made a very good point a little bit earlier this evening. He said there's no point in it session unless you're doing some background reading into the sheets and doing some examples and doing some practice and really getting into it. So I would strongly advise doing things like that because then of course this becomes a lot more productive if you just all understand. So that's what we've done so far. Let's take a quick look at variation 3 now. Dynamic breakout. So variation 3. Sushil, if you're still online and you're still listening, if you have a question, so feel free to call. I'll be happy to answer it, and I'm sure it will be constructive to everyone here as well. So, variation 3. Now, variation 3 and variation 2, very similar. The first variation 2 that we looked at, that was an inside compression. We remember that, yes? Inside compression. And remember how inside compression was defined. Inside compression was defined by distance from swing high to swing low. So we had distance and distance. And here, this range was within this range. You see this? Well, okay, this range within this range. Variation 2. Variation 2 is classed as a single market compression, or an SMC. Variation 3, on the other hand, is what we class as a extended market compression. And the way that that would look would be like this. We've got a high, we've got a low. Exactly correct. A symmetrical triangle.
The triangle one was the same, isn't it? variation
It's just forming a symmetrical triangle.
forming.
This is a little bit more defined.
Oh,
Yeah. Now, here's your lower high, and here's your higher low. And again, here's another lower high, and here's another higher low.
Yeah.
Can we all see the difference between the higher low, lower high, lower high? Can we see the difference between the two, the number 2 and number 3? And yes, of course, this is what is classed as asymmetrical.
the order would be either up, down, or
When you say order, you mean?
this order to go up and down.
Yes. No. Okay, now, there's a good question. So it depends which trend it's coming from. Okay? Now, the probability is higher. If it's coming from an uptrend, the probability is higher, low. Yeah. When the lower high forms first. Yeah. See, because here you have up to this point, definitely you have an uptrend. Right? And it's only when it's lower high forms this becomes a unestablished trend. Not downtrend yet, because remember there's a transient. It's not a downtrend just yet. We'll just class it as unclassified at that stage. Yeah? The lower high forms, then higher low forms, another lower high forms. This is a compression, an extended market compression. Single market compression, extended market compression. Yeah. Variation.
Then you press the order to go short.
Yeah.
And you cancel the order.
Okay. Just so you all know, the probabilities of this setup is 2%. Yeah, very low probability. Yeah, the probability of this setup just here, 20%. Yeah.
But when this happens, it's normally a big move.
Exactly. Why is it a big move?
Compressing.
Compressing.
Can I ask you a question?
Yes.
I'm not asking Rish, I'm asking this man.
Yes.
It doesn't like the when you break out and leave a large triangle.
Yes,
Isn't there a contradiction?
there is. Because a triangle is a breakout.
Yes, it is.
Every strategy can be classed into either a bounce off or a breakout. It is. So the lift off is what type of strategy? We're closing above the 20 moving, closing below. What's it doing? It's doing what? Yeah. It's using the moving average as what?
There's a floor, so it
Yeah,
bounces.
as a floor, or what we class that as in trading. Floor is
Floor is supposed
support.
ceiling
Do
resistance.
you remember this from Trader's Base Camp, the tennis ball, and we bounce it on the floor as support? Yeah, and on the ceiling we bounce it, it's called resistance. Yeah. So that's all it is. Very simple. Very easy.
I only trade the variation quick.
Say again.
I only trade.
You only trade variation, yeah, that's fine. Brilliant.
Okay.
Fantastic.
So 2%. Why is that only 2%?
It's very low probability of setup taking place according to this swing high and swing lows.
So
Do you trade a lot of triangles? Do
It's
you trade a lot of triangles?
not very.
Not many set up like this.
Not very.
Yeah.
There was recently in gold,
Yeah.
and one was.
And how long do you want to go?
2 months.
2 months, because you don't have any setups. Because this is quite rare. Yeah. What this actually is, so if I can look at this another way, right? Again, range. Here to here. What I'm teaching you actually, I'm saying it's quite easy, but it's actually very, very advanced, right? It is very advanced. So I don't think anyone, I've not come to anyone who can explain it in this way, right? So you've got a range here, you've got a range here, you've got a range here. So this range is within this range, is within this range. So what it actually is, let's take a step back from all of this trends and everything. Let's just look at 3 bars. Bar, bar, bar. This is a double inside bar formation. That's all that's happening here. Just in terms of range. So the probability of this setting up, very small. Yeah.
When it happens, it's really big move.
Yeah, exactly.
So variation 2 is the one 20%, isn't it?
Yes.
Okay. So this is for maybe uptrend or downtrend.
Correct.
Which direction? So what one was that?
So if it came in from an upward trend and we had some higher highs and higher lows going into this, the probabilities to the downside. Higher probabilities into the trade, the markets the trade short. Higher probabilities to the downside. Because the first lower high was formed here. Right? So up until the point that this lower high was formed, this was all an upward trend. Then the lower high came into the market. Then another lower high came into the market. So as the market squeezed, it started to compress, and what was happening is like taking a champagne bottle, shaking, passing the ball, boom, off it goes.
So is that why variation 3 is very explosive?
Very explosive. And it's also the reason, if you look at the journal and if you look at all the historical trades, there are only 22-minute variation of it.
No.
Good. So we've done 1, 2, 3, and 4. Okay. So what we'll do is very quickly then we'll just go over how to manage the trade once we're in. So are there any questions around this so far? And I would appreciate if you don't understand to ask the question and then we can all make some progress. I'm sure that there will be questions or maybe some niggling doubts about some aspects, or maybe all aspects. And it would be good to answer and then be very clear. Clarity is the fastest way to manifest anything. You know that? Clarity is the fastest way to manifest anything. If you're not exactly clear, then you elongate manifestation of whatever it is you want. And that's why. So you guys know about the secret and stuff like that? It's the secret. Yeah. Master the markets. Yes. Yes. Okay, good question. Let me put you on speaker and let me answer that. It's a very good question. Okay, hang on a second. Okay, so the question is, right, what is the relevance of the probabilities? Right, what is the relevance of the probabilities? So it's actually it's a really good question. So we know that, so for the inside compression like this, we know 2%. Why is that relevant to us? So the reason that this is relevant is because even though it occurs 2% of the time, what I then want to be able to see through placing trades is that rare setup, how, according to the rule set that I've built to trade that setup, what is the results set that I get from that? Because I know it's only going to occur 2% of the time, I know that to accumulate a trade sample of 20 trades, according to variation 3, is very rare. I want to know, according to the rule set that I've built, what is my results according to that. So once I have those 20 trades, I can analyze those trades, and I can then say, well, the probability of this setup actually taking place is 2% of the 20 trades. According to my current rule set, 90% were successful and 10% were unsuccessful. Of the 90% successful, I made, let's say, 6%, let's say 30% profit. Of the ones that were unsuccessful, I made a 4% loss. And if I trade this for 100 trade samples, these will be my results. Then I know that with that 2% variation 3, I can then scale my risk up to 2 or 3% per trade, because I have a set of statistics, and I set up a set of numbers that backs up what I'm talking about. And that gives me statistical conviction to trade bigger. Does it make sense? Yeah, that's a very relevant question. Does that make sense? Yes. Correct, because the frequency will be much lower. Correct, yeah. What it will be good to do is find that out on the trade journal that we keep. And that's the exact reason that we should log all of the entry reasons to the trade journal. So if any of you look on the trade journal in the live trading room, what's happening is we say entry reason, variation 1, higher highs and higher lows, 20 moving averages in that order, and that's the reason we're logging all of that. So now what we can do is go back and look at our trade journal and say, look, out of all of the, let's say, 55 trades that we've taken on dynamic breakout in 2014, 7 have been a variation 3, 25 have been a variation 4. Of the 25 that were variation 4, 80% were successful, 20% were unsuccessful, so we can log all of that. We've logged all of that, and we can analyze what variation works best. So then even when a variation 4 then sets up for us, we know we risk the whole percent on it, or just 2%, once only if we have numbers. So to answer your question, do we have that logged in? Yeah, no. Do we have all of the data to derive that information? Yes, we do. It's all on the journal. Yeah, brilliant. Thank you so much. So that's the dynamic breakout variation 1, 2, 3, and 4. Let's take a quick look at how we manage the trade once we enter it.
Can I quickly ask?
Yes, absolutely. Please do. Yes, I love you.
Before I came to master the market, I used to trade breakout strategies using horizontal support or resistance.
Yes.
One of the dangers of doing so were fake outs, whereby the price pretends to make a break,
Yes.
and then it reverses and goes all the way. How do we avoid this with when we do dynamic breakout? How do we avoid fake outs where the price pretends to go one way and go
This is a very advanced question, it's a very advanced question. It's a very good question to ask. Now, there's a reason that you're seeing these fake outs. Okay, and what I would do is you can look this up. There's a gentleman that's going to explain this a lot better than me. His name is Martin Cole. Martin Cole, and he's on YouTube. I believe his channel is called Learn to Trade, I believe. Right? Now, he talks about market makers methodology. And inside market makers methodology, he talks about 3 phases the market has. The first one is accumulation. The second one is manipulation. The third one is called profit warnings. Now, in a very, very broad and crude nutshell, I'll summarize. Let's say the market was climbing for a while. So the OHLC bars were climbing. Then suddenly what starts to happen, this is how you will class horizontal support and resistance. You will look and the market will start to consolidate like this. Right? And you will class your support and resistance. Then what happens, what's happening here is what Martin would describe as accumulation. Market makers are accumulating orders. Then what happens is the market makers trick people, manipulate them, and the price moves higher. The crowd jumps on board. What does everyone do at this stage here? The retail public, what do?
They buy.
They buy. Now, for us to buy something, would it be fair to say someone has to sell something?
Yes.
So the market makers sit back, they relax, and they sell to the people who want to buy. People see the breakout, they jump on, they want to buy. Market makers are like, no problem, I'm going to sell. Remember, the market makers are the ones that make the market. They control the bigger money, right? Right, yeah, no problem. Come on, yeah, you want to buy some more? What, 500,000, 550 million? Yeah, there you go, no problem. They got the big money, they got no problem. They got deep pockets. Yeah, you want to buy some more? Yeah, I've got some more for you. No problem, buy 5 million here, 12 million here. Price moves up, manipulated. Then what happens is we enter the final phase, which is profit release, which is when the market starts to. And at this stage, this is where the crowd jumps out, and of course they bought here, so they must do what to get out. Then so we're selling, someone needs to buy. So the market makers pick up everything that's left, and they push the price lower. Right? So there is a accumulation of orders, first of all, a manipulation in price, and a profit release. This is probably what you're experiencing when you're talking about fake outs. This fake out is called manipulation. So how do we prevent manipulation in this dynamic breakout? Yeah. So the way that it's, in fact, the honest answer is, it's very difficult to prevent the being manipulated by those spikes. So sometimes you will see in our dynamic breakout trades, you will just spike in and the market will turn around and it will go straight away the other way. Now, the way that the dynamic breakout, the live trading version, actually enters late. If you look at the dynamic breakout, it actually enters the market very late because you've already got your trend established. The price has to move higher, get it in the market here, and then the price carries on moving higher. At this point, the profit release has already taken place. And so we're just getting in after. Actually, we're getting in quite late. Yeah, we're getting a late entry. But it's a late entry that's safe. Yeah. But the disadvantage of that is the move won't be as big. You won't catch as much of the move because you're getting in late. But you're getting in late, so you're safer. Right? If you get in earlier, you're going to catch a lot more of the move, but you're going to get stopped out a lot more too. Right? So that's so how we prevent it is we enter the market late. Which has pros and cons. So that's how we prevent all this. But look this up because this is pretty cool stuff. And I've learned a lot from Martin. And we talk about this in Traders Toolbox as well. It's very important. So let's start one. So what we're going to do is dynamic breakout. Once we enter, how do we manage the trade? How do we manage it? Yeah. So let's say we enter the most basic dynamic breakout variation 4. We enter the market here. And our stop loss is here. So, for the dynamic breakout, how we now manage this, is we look, if we're going long, we look for 3 buyer bars, right?
After the
Including the bar that breaks down, yeah, including the bar that breaks down. So buyer bar 1, 2, 3. Let's look at the light trade. That's an alarm for the light trade. So we have 3, right? 3 buyer bars that we're looking for. And only on the 3rd buyer bar do we trail the stop loss to the low just here. The low of the 3rd buyer bar. If we have 1 buyer bar, 2 buyer bar, seller bar, there's no stop to trail. If we get another buyer bar after that, then we'll trail the stop loss to the low.
So it's not just 3 in rows.
No, we're just looking for 3 buyer bars. As soon as 3 buyer bars form in any order, we'll trail our stop loss.
So once you trade, you have to make another trade.
Yes. Another 3 to trade again.
So
Then you may get,
Not
no,
including that one.
not including that one. That's the one, 1, 2, and 3. So not including that one. Teller bar, buyer, then you'll trade again.
Right.
Yeah.
Another free.
Yeah. Does it make sense?
Yes.
This is how we manage the trade. And it's of course reward risk of 2 to 1, so we're looking for
Variation 4.
variation 4. We're looking at 2 times the trade risk for our target. So we've just had a dynamic breakout on euro dollar. Just hit target
There was
today.
one in euro yen.
There was one euro yen a few weeks ago, yes, I think so at least. Yeah, I think he was successful for us.
So difference between 1 and 4.
1 and 4, yes. So 1, remember, is a defining breakout. If market breaks, moves the other way. So 1 would look like this.
Oh, yes, yes.
High,
4 the other way.
high low, high
4 is what
high.
you started off with.
And 4 will look like this. Yeah. That's a 4. And that's a 1. Any other questions? JB. Pretty cool, isn't it? Yeah. No questions, you know what I always say on the questions, right? I've got a universal line for that.
So the question I'll do, the price one.
Yeah,
Not that clear on it, so.
it's not that clear on it. Should we
Well,
cover
next
it
time.
quickly? Should we do it now? How do we feel? Do we feel a little bit blown? Or?
Next time.
Next
I
time.
would rather next time.
Alright.
It's up to everybody else.
Next.
The reason why, because I see expiration 5 and I'm
Yeah.
not clear with it
Okay.
completely.
Yeah, it's just there's a little bit extra to it. That's all.
Is it the 1 is down, and then 4 is
Yeah, 4 is in, not necessarily, because it can be down as well. It can be for downtrend. But the difference between 4 and 1 is 4 is in line with the overall trend. It's a trend established breakout. The trend is already established and we're just breaking out. In variation 1, what's happening is that it's a reversal. Uptrend becoming downtrend, or downtrend becoming uptrend. That's the
So variation 4 is a continuation. Variation 1 and
the reversals. That's the best way of putting it. So that's it. Any other questions? Okay. Wrap up. Does anyone wanted to discuss anything else? We've got a good 10 minutes or so. Any niggling doubts about stuff that you were looking at that you were unsure about? I know this will have brought a little bit more clarity to the dynamic breakdown. So, yeah.
What would you do every week? Say, because I can only come every 2 weeks.
Okay.
You do like a different topic every week?
No, what we're going to do now with these weekly planning sessions, there's some stuff going on. So with these weekly group coaching sessions, right? What we're going to do is now we're going to rotate. So we're going to do 1 week beginner and 1 week intermediate. 1 week beginner, 1 week beginner. So more than likely, Kira will take the intermediate and I'll take the
This is beginner.
This is somewhere in between.
Okay.
But no, we haven't started yet, but that's the plan now because we want to do some stuff, a little bit more stuff with these guys. They've been training a little bit longer. And then first my beginners, certainly, and the new people that have joined our live trading room just recently, we want to just give them the basic stuff they need to get going. So.
Because I can work my routes between that, so that's what
Yeah, definitely. So that's the plan. As soon as we implement it, we'll send a text message out. You all got text message today?
Yes.
So, yeah. So we'll send a text out and we'll say, hey, this is the plan.
Yeah.
So then that will be there, and then you can work it around whichever session you want to fit it. This is probably this is probably because this matrix of the live trading. Yeah, these guys are doing more stuff like variations around lift off and how they can get in early and stuff like that. So,
Oh, yes.
yeah, so different stuff like that. But come to my session, it'll be cooler.
Focus on the both of you. I might be.
Hey, look, are you using parallels or are you using crossover?
Cross here in between. But I do most of my trading on my Windows one.
Yeah, it's one that lets you access
It's a
Microsoft
software emulation.
applications on your Mac.
Oh, right,
But you
okay.
can't
Yeah.
do an operating system.
So what's the difference? Apparently, I'm crossing.
They do the same thing.
Something,
Yeah.
Especially we use like a blue.
Alright.
thanks very much.
This one is red.
I was just
Yes.
emailing it to you. Yeah, I want to cut this.